What we're saying is that we're going to get through this, but it's going to be a long slog. And we're telling Canadians, and our forward guidance has been very clear, that we're going to hold our policy interest rate at the effective lower bound until slack is absorbed, so that we can sustainably achieve our 2% inflation target. And we've indicated that's not going to happen into some time into 2023. So what does that mean? Yes, it means that if you're a household considering making a major purchase, if you're a business considering investing, you can be confident that interest rates will be low for a long time. Clearly, we are seeing a resurgence of the virus. It's happening in Canada. It's happening elsewhere. As we've indicated in the report, after a very strong third quarter, we always expected fourth quarter growth would be a lot slower than the third quarter. With the rising number of COVID infections, we've taken something off that. So our fourth quarter GDP growth is now barely positive, 0.2 quarterly or 1% annualized. Hopefully, as we come through this second wave, things will pick up again. But what we tried to outline is that we expect there will be successive waves of this pandemic. Hopefully, each wave will be a little smaller. We'll get better at managing them, and that's what's built into our base case. We also assume in our base case that we don't get vaccines aren't widely available until middle of 2022. It could happen. That could happen faster. That would be wonderful. There are certainly scenarios where a vaccine is available early next year, and it proves effective, and we can deploy it at scale so that by the end of the year, we don't need to physically distance anymore. On the other hand, there are scenarios where the early vaccines aren't as effective as hoped. There are scenarios where a second or third wave is worse than expected. And so, the assumptions that we've made underlying our outlook try to balance these various possibilities.